Stop what you're doing. Seriously, if you own semiconductor stocks right now, you absolutely need to hear this. Welcome to the Explainer. You know, everyone is completely obsessed with chasing the next massive AI bubble. But what if the most deeply undervalued tech stock is hiding right in plain sight? Last week, I ran United Microelectronics Corporation, or UMC, through 5 strict valuation models and the legendary checklists of both Warren Buffett and Peter Lynch, and I've got to tell you, what I found completely shocked me. Think of the semiconductor industry like real estate. While everyone is distracted by the flashy luxury developers building those ultra-expensive AI processors, UMC is quietly monopolizing the highly profitable commercial real estate in the background, just raking in cash flows.
Let's kick things off with a staggering statistic that should literally make you sit up in your chair. 108.1%. That is UMC's massive year-over-year net income jump in just the first quarter of 2026. Now, I know a lot of retail investors are terrified right now of buying at the absolute top of a semiconductor bubble. So how on earth is UMC pulling off triple-digit profit growth with only a tiny 4% market share in a cooling demand environment? Well, by the end of this explainer, you'll have a clear, actionable framework to know exactly if UMC's current intrinsic value makes it a screaming Buffett buy or a dangerous Lynch value trap.
To get there, here is our game plan. We'll quickly cover the GlobalFoundries landscape, dive into UMC's Q1 financial surge, break down their revenue by tech, look at their huge 12-nanometer Intel partnership, and finish with their future outlook and pricing strategy.
All right, Section 1, the GlobalFoundries landscape.
When we look at the data from Counterpoint Research tracking Q4 of 2025, TSMC is just dominating the space, right? They've got an incredible 72% market share. Samsung and SMIC trail far behind at 7% and 5% respectively. And then there's UMC holding a very solid specialized 4% niche right alongside GlobalFoundries. Also keep in mind, the pure-play foundry sector as a whole actually grew 20% year over year during that quarter.
But here is why this is so fascinating. You really don't need a massive piece of the pie to generate staggering profits, as long as you optimize your specific niche perfectly. Sure, a 4% market share sounds tiny compared to a giant like TSMC, but UMC's mastery of their specialty processes turns that small slice into incredibly efficient, reliable revenue.
Which brings us to Section 2, UMC's Q1 financial surge.
Diving straight into UMC's financial presentation, specifically looking at their year-over-year statements of comprehensive income, we can trace exactly how they're winning. Their operating revenues actually only grew a fairly modest 5.5%, sitting at just over 61 billion new Taiwan dollars, but jump further down that statement and their net income skyrocketed 108.1% to over 16.1 billion. Pulling off a 108% profit jump on just a 5.5% revenue increase, that is an absolute masterclass in margin management.
The real story here is the sheer operational efficiency behind all that cash. They drove an earnings per share of 1.29 NTD. And honestly, here's the kicker. They did it on a 79% capacity utilization rate. That means their fabs aren't even running at absolute maximum capacity, yet they're still hitting record profitability. It just proves UMC isn't playing a volume game. They are highly strategic about what they manufacture and exactly how efficiently they do it.
So, what exactly are they manufacturing? Let's get into Section 3, inside the revenue breakdown.
The absolute engine of their revenue sits squarely in what we call mature nodes. When we break down their foundry segment sales by technology, those 22 and 28 nanometer technologies really steal the show in the first quarter of 2026.
Isolating that Q1 data, the 22 and 28 nanometer node makes up a massive 34% of their total sales. Combine that with the 40 nanometer and 65 nanometer nodes, which are bringing in 18% each, and the whole picture just clicks into place. This revenue from mature nodes is totally cementing UMC's status in specialty process niches. They are the ones providing the essential, everyday workhorse chips that massive industries like automotive and the Internet of Things absolutely depend on.
And to maintain that edge, they aren't slowing down. UMC has earmarked an aggressive $1.5 billion for their 2026 capital expenditure plan. Crucially, 90% of that budget is targeted directly at expanding their 12-inch wafer capabilities, ensuring they can physically scale up to meet all this future specialized demand.
Next up is Section 4, the 12-nanometer Intel partnership.
This is a huge move. Mapping out this 12-nanometer partnership, things have been moving really efficiently since they first announced it back in January of 2024. Right now, the production process is undergoing certification at Intel's massive campus out in Arizona. UMC expects to wrap up that certification by the end of this year, late 2026, which means they are slated to officially hit mass wafer production on this node in 2027.
Now, why is this specific node such a big deal? Well, this partnership specifically targets FinFET capabilities. If you're not familiar, FinFET, or Fin Field Effect Transistor, is a total game changer. It's a 3D transistor structure that drastically improves efficiency. It basically allows a chip to run much faster using the exact same amount of power, or to run at the same speed using way less power. Teaming up with Intel here allows UMC to offer these highly advanced capabilities without having to swallow the astronomical costs of building a brand new fab from the ground up themselves.
Finally, let's wrap up with Section 5, Future Outlook and Pricing.
UMC is strategically shifting its pricing model to make sure they don't lose any ground. For the second half of 2026, they're planning selective price adjustments. Basically, they're protecting their long-term contracts, but any new orders or newly ramped capacity will see a price bump. But check out their 2027 strategy. They're pivoting to broader customer negotiations. That strongly signals potentially larger, more widespread price increases across the board.
And these hikes, they aren't just arbitrary. They are a direct necessity driven by rising global raw material costs, plus the massive financial undertaking of expanding their Singapore facility. They're in the middle of scaling that specific manufacturing hub from producing 12,000 wafers a month to a whopping 18,000 wafers a month. That level of physical expansion requires serious capital, and tweaking their pricing is exactly how they maintain their balance sheet.
So, let's bring it all back. Does this make UMC a true Buffett buy? With rock-solid strategic partnerships secured, massive capacity expanding in Singapore, and an incredibly strong defense of their profit margins, our 5 valuation models suggest a highly resilient intrinsic value. Will these bold moves push their market share beyond that 4% mark? Well, the data certainly suggests they're primed for it. Thanks so much for joining me for this explainer. Keep analyzing and keep learning.